Welcome everyone to Chatham County Cooperative Extension's webinar, Farm Tax and Business Management 101 with Guido Hoeven. So Guido, if you are ready to share your screen, we're ready for you to start.
All right, Debbie, I'm going to pop it up. Everybody should be seeing the first screen. Is that true?
Yes, looks great.
Okay, great. Well, good evening, everybody, from sunny Lawrence, Kansas, where I now reside. It is fun to, when folks were introducing themselves and see, hey, I'm from Trenton, I'm from, Pittsburgh, I'm from, all the places that in the time that I was at NC State, I went to and traveled and through or made presentations there. And it's just really great to be back in North Carolina, if only virtually. And I'd like to thank Debbie for the opportunity. She and I have had a good working relationship, as she said, for the over past 15 years. And we hope that tonight's presentation continues that. What I'd like to emphasize is that we are going to be looking at farm tax issues. So not only just income tax, but some of the other tax issues. And then there are other subsequent presentations that are going to be coming in the next several weeks. And also there's some just broader business information that folks may be very aware of who are on the call on the webinar today, or they may say, oh, that's what I need to think about. I have worked in farm management and in the area at the intersection of farm management and taxation for a little over 35 years. Presently in my retirement, although if you ask my wife, is he really retired? Probably not so much would be her answer. But I do some independent consulting, and most of that is in teaching and in education work sometimes with individuals. So having said that, and welcome, let's move into the next slide. And this is kind of where we're going tonight. These are broadly the presentation topics that I want to cover. And looking at the character of income. And again, my focus is coming from putting numbers, putting information onto a tax return. And so trying to figure out what the character of income is, why is it important? And likewise, we'll talk a little bit about on the character of expenses, because I mean, if you got character of income, expenses do have sometimes a little bit of a character to them, and we need to think about those. We're going to look into from the income tax code, and this will be the federal code. We'll look at what are farmer definitions and broadly, and then we'll also try to answer a question, what's a farm? In my work as an extension specialist, and Debbie and I would have communicated via email or phone call. She would say, hey, Guido, so-and-so called me up the other day and they're asking about this. Is this a farm? And the first question I look at is, okay, let's peel the onion. Let's have a little bit of context. And so that's why it says, for which purpose are we talking about? We also get questions. Debbie gets questions. I used to get questions about, what's a farm number? And again, it depends on the context of those questions. And I hope to kind of answer some of those. And some of you may already say, oh yeah, I think I got a handle on that. And then we'll look at, as an introduction to Schedule F, we'll look at Form 4562, which is another tax form. And we'll also look at Form 4797. Those three forms really kind of are the nuts and bolts. But I'm also going to contrast Schedule F to Schedule C, which is in the context of the sole proprietor, is the non-farm sole proprietorship. And then Debbie's asked me to very briefly, 50,000-foot view, look at farm entity business structures. Now, I know that there is going to be another webinar later on this year. I believe it's going to be over the summer, where Andrew Brannon, who is the extension specialist and an agricultural attorney on staff at NC State, is going to be addressing farm entity business structures and what might make more sense. And this is kind of an introduction, a little bit of a teaser, if you will, to that particular presentation. And then there's been some questions relative to present use value that popped up. So we'll have that in the presentation. So this kind of is a little bit of a roadmap of where we are going to go tonight. And as Debbie said, I've got a couple of slides in there that just basically says any questions. So that's a place for us to pause. Maybe I spoke and you may not have caught it. You want to have a little bit of clarification. So probably full disclosure, since I've worked with this topic and at this intersection and have prepared tax returns professionally in a former life, I can get into the weeds pretty quick, and I've really tried not to with this presentation. I'm not trying to show off how much I know, but as we will discuss things tonight, in the context of taxation, whether it be federal tax, whether it be present use value, words have certain meanings, and we need to kind of be aware of what those meanings are so that we can have a conversation where both parties work. So that's a little bit of a disclosure. So with that, why don't we dive into the first topic that we go. And that first topic is looking at the character of income. And that is a taxee's word. It means something to me when we look at it. And here in this picture, you can see kind of that this is at a farmer's market and that cash is being exchanged for the products that the particular vendor is selling, whether it be peppers or whether it be tomatoes or green beans or sugar peas or melons, or, you know, it looks like there might be maybe some eggplant there just a little bit. But earned income, and that's in bold on this slide, when you think about that, you say, okay, I went out and I got a job. And, you know, at NC State, I was employed, I got a W-2, so I earned my salary. And that is true. And that would fall into the lower part when you see wages. So I would get wages and salary. And that, what it really boils down to get to the point, is that earned income in the context of taxation is that income that is generated by an individual, either through self-employment or through wages or as an employee, that is going to be subject to Social Security tax. In the context of self-employment, that's going to be coming from the net income on Schedule F or Schedule C. Could also flow through to the individual if there was a partnership that they participated in, and the partnership's profit is going to be shared on a pro rata basis. And we'll talk a little bit more about that in the entity discussion. It also could come from consulting, such as what I'm doing this evening. I'm self-employed in this particular thing. It could also be personal services. So it could be nanny, a nanny tax. You may have heard that in the popular press. So we have that. That is the income that we consider that is earned income. Again, that income which is going to be subject to Social Security tax. And at the very bottom of the slide on the lower left, you see the statement say it's subject to ordinary and Social Security taxation. Ordinary meaning that in the context of federal tax, that we have a progressive tax scheme or a progressive tax regime where it goes from, and there is income that comes to individuals that's not subject to tax, because we have things like a standard deduction. So that allows, that's a subtraction from income in the calculation of where we get taxable income. But then we have a 10%, a 12%, a 22%, et cetera, all the way up to 37%. But for a married individual, we've got to get over $600,000 of taxable income before we're being taxed at 37%. And remember that so far, right now, we don't have 100% tax rate. So you do get to keep some of it, although sometimes when you think about all of the taxes that we pay, whether it be sales tax or fuel tax or whatever, we're paying an awful lot of tax. But tonight's focus is going to be on income tax, and then we'll dive off in a couple of other areas. So again, just to highlight, earned income in the context of our broader discussion tonight is that net income from Schedule F or Schedule C, that is from self-employment, and it's going to be subject to our ordinary income tax as well as also Social Security tax. Our next one, which folks might be familiar with, is what one calls passive income, or this is where we have made an investment in capital and certain areas, and that income that gets generated, the return on that investment is then deemed to be passive. So rental, for example, you'll see that it says apartment for rent there on the right-hand side. That is a passive business by definition. And we have to watch out in the tax context also for the passive activity loss rules. So if there's a loss, can we take the loss currently against other income? And the answer to that is it depends on how much other income. There is a allowance for up to $25,000 from those rules, as long as we don't exceed a certain threshold of income. But we also have investment returns, so it's kind of looking at the annuity rates there in the lower right-hand side, just thinking about that. It could be interest from CDs or at the bank, or it could be investment returns as well. You know, if we're at Edward Jones or we're with Charles Schwab or, you know, Fidelity, those kind of things. So those are passive. The money is working for you. I think the one thing that one quote from Warren Buffett is that we need to get to a point where we have money at work for us while we are sleeping. That is the investment returns. And these, another one is going to be from, as listed there, is from limited partnership interests. So we might be in a limited partnership by choice, that we like the business model, but we don't want to be involved in the management or make any management decisions, but we do want to return, and that would be a limited, and that is a special case. But those are going to be these passive income. When there is income, is going to be subject to ordinary income tax rates. That's the 10, 12, 22%, et cetera, but not Social Security. Now, in the highlighted one, it says not passive rental income. And this is when we're looking at some special circumstances under the tax code and how that is going to be applied. So the first bullet there is for Airbnbs and like farm stays. And there's a picture there, Lizzie Lou's farm stay. It's there in the upper left of the pictures on the slide. And this is typically going to be for less than 7-day long rentals. There's a little blur there between, you know, it could be 7 days one, and then 7 days somebody rents two for 2 weeks. It would still fall under the same rules. But with Airbnbs and farm stays, there's generally some private and personal services that are provided. The beds are made, the linens are washed. Now, they may be washed after the people leave, but what it means is if Guido and Emily come to Lizzie Lou's, our expectation is that there's going to be a bed with fresh sheets on it. There may be, oh, here's some bottles of water, and here it may be some snacks, those kind of things. Those are the professional and personal services that are being provided that are extraordinary, as opposed to if you rent the apartment, well, who's going to make the bed? Well, it's the tenant. So there is that differentiation. Another one is vacation rentals by owner, the VRBOs, the rental of personal property. So sometimes folks may engage in that, and you'll go, for example, if you don't have a rototiller, like I don't, but I want to go till up the garden, I'll just go down the road and rent one for the afternoon. And that way, that type of rental is going to be subject to Social Security tax, as you see listed there at the lower bottom. Subject to ordinary and SC tax. These non-passive rentals, they technically are to be reported on a Schedule C as a non-farm sole proprietorship in that context. Now, they may be, as we'll see, can also be an LLC or a sub-S corporation that can engage in that activity. But what I want to say is there's a difference between passive income and earned income. We're still being subject to ordinary income tax rates. The next one is capital gain income. This is from long-term investment gains. So, if an individual might have a brokerage account and they invest in, stocks and such things, and they hold them for the long term, typically over 1 year in length of time, then it becomes long term. That's the definition under the code. We have North Carolina being covered with trees, 60% of its land mass. Timber is a quite a frequent source of income to North Carolinian landowners, and most times they're not in the business as an individual, so that timber harvest, that timber sale is going to be treated as a long-term investment return, and it's going to be treated as a preferential capital gain type of income, which then will receive either a zero tax rate if we're under a certain threshold, and that threshold for 2023 is about $68,000 this year. If our total income, taxable income, is above that, then we're at the 15% income tax bracket, and then we'll go up to about $460,000, give or take. And then above that, it gets taxed at 20%. So we have essentially 3 capital gains rates, 0, 15, and 20. And you might recall just a moment ago, I said, well, the highest ordinary income tax rate is 37%. Well, it doesn't take a rocket scientist much to say, oh, I'd like to get my income as capital long-term returns, because then my maximum tax rate is going to be 20. And that's 17 points less than the highest ordinary rate. So this is what we're looking at and what we talk about with the character of income. Now, from a farming perspective, we also have something that's probably unique to businesses, and not just farming itself, but we have the sale of business assets. And this would be those items that we use in the production or in our own items, which and we're selling those, and it's going to be subject to depreciation recapture, such as tractors and equipment. That's going to be taxed at ordinary income rates, but not subject to Social Security. Now, we also have some assets that in the legalese or the taxes are going to be treated as 1231 assets. Those are going to be raised breeding, dairy, and draft animals. Now, for them, the long-term holding period applied is going to be 24 months. So these little gals that are staring at us in the picture here, we've got to hold on to them for 24 months. And if they become, if the udder becomes infected or they become less productive, we may sell them. But our intent was that they were producing milk, and so we would sell those off. Also, in the context of farming, timber comes back in there. There may be a little bit of ground on the back, 15 acres or 20 acres, and we sell it. Well, it still would be treated as a long-term investment. And then sometimes land opportunity comes up to say, hey, I want to buy a piece of land closer to where I am, and then maybe we are willing to sell a piece of land that's a little bit farther off in order to become a little bit more efficient. So generally, in these contexts, we're going to have capital gains that are going to be applied to what's listed here as 1231 assets, but where the depreciation recapture is for this, in the issue there is looking at the tractor and the disc, if we sell those or if we trade those. And since the Tax Cuts and Jobs Act of 2017, when we trade personal property, such as the tractor and the disc, that's going to be deemed to be sold to the dealer for whatever the trade value is. And so we're going to recognize that as a sale and report it as part of our taxable income, even though we didn't get any cash in hand. But then we turn around whatever we are trading for, another tractor, then we're going to be able to take what we actually pay for that tractor plus this trade value will be able to set the entire amount from those two values up for depreciation and then recover that total cost. And we can choose to do that in several different ways, and we'll talk about depreciation maybe a little bit later on. But I'm just trying to illustrate the character of income from an income tax viewpoint, and this is why it's needful to think about what that transaction is, and also what was the owner's intent for that particular transaction. Which gets us to this point, and that is that records are going to be able to separate the income and expenses by character. So the record keeping system needs to be able to account for these types of income and these expenses. So we're going to have either current farm or other business income. We're going to have the sale of business assets. Now, some of those are going to qualify for the 1-year holding period, such as timber. But if we're selling off livestock, such as breeding cows or dairy cows, then we have the 24-month holding period, and we need to have some record of that. When did we acquire them? When did we hang on to them? And then when did we get rid of them? What kind of income is it? Is it passive income, or is it a capital gain type of transaction? So again, looking at those things within the record keeping system should help us when we communicate either with ourselves, if we are self-preparing the tax return, or if we use a tax preparer, then we need to have that communication through the record system that says, here, this is how I did it. There may be some clarification and some back and forth between in the preparing and the processing of the returns. Now, the quote down at the bottom, I got that from my wife. My wife is a registered nurse and has had a 30-plus year career in nursing. And the one thing she remembered way back in nursing school was the admonition: if you didn't record it, if you didn't chart it, it did not happen. And so this is really important to think through and make sure that our record keeping system is helpful to us down the road, because what may have occurred in January, you might not be remembering back in November or in December of the year as you're closing out. So again, trying to record that and help make those items come easier to mind when we're preparing the return. As I said, the similar rules apply to the character of expenses. So this is kind of on the other side of the coin. And relative to those expenses, from, again, an income tax perspective, are these expenses startup expenses? So if we've got any folks that are beginning farmers or are thinking about beginning farmer, what's a startup expense? Well, it's basically all of those expenses that you incur prior to the business beginning to function for the purpose that it was set up for. So if I'm going to grow wheat, for example, getting, if I want to organize my farm in some kind of entity besides a sole proprietorship, and it requires, articles of organization, as in an LLC, for example, the attorney fees that I might incur doing that, if I engaged an attorney prior to me renting land, if I rent land and then planting and tilling and then getting the land and then the land sown, that would be a startup expense. Those are going to be allowed to be deducted in the current year up to $5,000. And then anything typically over between $5,000 and $50,000 gets to be amortized over 180 months. That's 15 years. I think that's a little bit absurd, but that's the way the rule is. And anything over $55,000, which is the $50,000 plus the $5,000, then everything has to be amortized over the 180 months. So that's why we're looking at, and we need to know what's the character, what is done there. The second bullet there is, are these expenses again, in the quotation here, this is the language of tax, are these ordinary and necessary business expenses. So if we've got an ongoing business, an ongoing farm, let's go with a cut flower business. Well, what kind of cut flowers are you doing? Well, we're going to do tulips and we're going to do gladioli. Okay, fine, fair enough. What would be an ordinary or necessary business expense that pops to mind? Well, maybe the bulbs. The bulbs are going to be purchased. We're going to plant those in the appropriate time. It'll go through the winter, and then in the spring, these flowers will come from the bulb. They'll get ready, and then they get harvested, and then they get into pots of water, and then you go to the farmer's market. That bulb, that cost of that bulb is going to be a seed/plant cost. It's ordinary and necessary because you need to have the bulbs in case, because you want to sell tulips and gladioli. It could be veterinary expenses for your livestock, those kind of things, fertilizer, diesel fuel, gasoline, all of these that you would think ordinary and necessary in the context of running your business model, your particular farm. Well, what about the expenses that are next? They're in bullet number 3, capital in nature. Well, here we think a little bit more about, okay, did I buy something, a piece of equipment? Well, that's capital. It's personal property. Let's say we bought a tractor, paid $40,000 for it. Well, we want to put that in the capital expenditures account that we bought that, which would tell you or tell your tax preparer, we have $40,000 that we need to address as some kind of depreciable asset. And then we have various different ways to depreciate that, whether we use bonus depreciation, which is under the current law, and the presumption is that it will be used. And for 2024, we can take 60% bonus, whatever we paid for on that. And then the remaining part is going to be depreciated using the modified accelerated recovery system under depreciation over a 5-year period because it's an agricultural asset. Or we could have expenses that, hey, what I did was I bought some land and I engaged a surveyor. I engaged an attorney to help me close the property. And so I've got some of these other fees that are related to and tied to this transaction called a land purchase. What do I do with them? Well, most cases, they're going to be capitalized into the cost of the land and then not deducted currently because they're tied to that capital expenditure. Fourth item there, looking at that, is that these are personal expenses. Well, we're living on a farm. Now, when I did a lot of farm management work, one of the things that I said is you got to have a personal family checking account and you got to have a business checking account, and you don't mix the two up. And so what you would do is you would take, we need some money for groceries. Well, we take a draft. So you take $1,000 draw from the business account and it goes into family living so that you kind of keep the business side separate from the personal expenses and do that. And I've had several old crusty farmers tell me, well, that's just a waste of $10 a month. I'm just going to throw everything in one checking account and run my family and run my business out of one. And I go, okay. But then again, going back to the record keeping system, we need to have some way to say that this is personal and versus business expenses. So again, character of what you're doing, what we need, and what these purchases and expenditures are going to be is really important. And we'll mention it. We've already mentioned it once before, but we do have a separate webinar on February the 21st coming up where we're going to discuss expenses in more detail. And we're really going to there focus on items 2 and item 3 here, which is the ordinary and necessary business expenses, as well as looking at what's capital in nature. So that gets us to our first questions break. Debbie, did you have any chat questions in the chat?
We do have some questions. So when you were talking about the character of income under the sale of business assets, can you explain what depreciation recapture means?
Okay, no, that's a fair question. Depreciation recapture means that, and it's an application, again, taxes, apologies, I didn't make the rules, of something called the tax benefit rule. And so the tax benefit is to recover the cost or to be able to expense the cost of a capital item. Let's use a tractor again for $40,000. And let's say that we have had that tractor now for 10 years, but we need to get a slightly bigger one or a slightly newer one. And we are going to sell that tractor, and we sell the tractor for $20,000. So we bought it for $40,000 and now we're selling it for $20,000. But over the course of the 10-year period, we have recovered, deducted the $40,000 of the tractor's value, which was what we paid for it over time. Now that same tractor, and I'm just keeping the math easy, it's been sold for $20,000. So depreciation recapture means we have to recognize that $20,000 worth of income that comes in. And there's a calculation that's done on page 2 of 4797. The net result of that, which in our example would be $20,000, is calculated, and then it transfers to page 1 of 4797, and then it becomes part of ordinary income tax calculation. It's a source of income on the return, but it's not going to be earned income in the context that is subject to Social Security tax. So that's what depreciation recapture is.
All right, thank you, Guido. And just so people know, Guido and I are hoping and planning to offer a webinar specifically on depreciation later this year. Okay, so we're going to keep going with a pretty fast clip here so we stay on time. Regarding the sale of livestock, aren't sheep and other smaller livestock exempt from the 24-month requirement?
Yes, that's why they're not listed. And that's why you have to hold them 1 month, 1 year. So sheep, hogs, and goats would be for breeding purposes. So they're the mamas and the dads. Those have to be held for 1 year.
Great, thank you. On the sale of business assets and livestock, does this apply to honeybees and hive hardware?
Okay, it would apply to hive hardware, but not so much to honeybees, because honeybees, even though you may get a queen and pay some money for a queen, you're going to typically write that queen off as an ordinary and necessary expense. Now, if you sell the hive, the actual physical construction of the hive with the bees in it for an amount, that'll just come in as ordinary income on Schedule F.
Okay. Can startup costs be deducted in back-to-back years? Is the maximum allowable deduction per year or per business?
It's going to be per year. So if you have some expenses in November, December that don't cross the $5,000 threshold, you can write those off in the current year. And then in January, you've got another $5,000. You could write those off in that subsequent tax year as a startup expense. But then we hope you're starting your business in March of the year. Now, there's a little bit of a caveat there, because they're going to look up, IRS will look up and say, well, wait a minute, folks, you're talking across 2 different tax years here. And I need to be really clear. Those startup expenses under the general rules are gathered and then capitalized in total. So they are going to be limited to the $5,000 in the year that the business starts up. It used to not be that way. So I need to kind of back up a little bit with what I said, because I was thinking about reforestation expenses a little bit. But but startup expenses do need to be capitalized, and you're going to be limited to $5,000 in the year that the business starts. And then anything over that $5,000 has to be capitalized. I hope I clarified that.
Okay, well, if that wasn't clear, they'll let us know. Question about services like surveying land. If I bought property to live on and a few years later decide to start a farm and I have the property surveyed at that time, where would that fall? The farm doesn't own the property, so it isn't being amortized.
Okay, so if I'm understanding the question, then the person is renting the farmland. There's a survey done that they incurred and they're now farming. That would go under, in my view, if that's the case, that would go as a professional services fee and would be able to be deducted in that year.
Okay. Couple more questions. For rental on the farm, like Airbnb, are there rules out there that we can follow?
Yeah, the rules are that the Airbnb is going to be a Schedule C business. And so it's not a farm business. It's not, you may be using farming assets. I've seen a really nice Airbnb out of a 10,000 bushel grain tank. It's really kind of cute. But that is a rental personal services business, and it is Schedule C. And there is, I believe there's been recently published what's called an audit technique guide for those businesses. And it kind of gives a rundown of how IRS perceives that business and what questions they might ask. And also that's an educational tool for the auditors.
And the last question that I see for this section, if I have a working farm and use it as a venue for professional photography and weddings, how does this separate out for taxes?
You have, you'll have again a Schedule C business and a Schedule F business, and it's kind of tough. I'll cover that in just a little bit when I contrast Schedule F and Schedule C maybe a little bit more clearly. So if I don't answer that question clearly, we'll get to it.
Okay. And Guido, just to give you a time check, it's 6:45.
Oh, it's 5:45 here.
Yeah,
We're just getting started.
you're on
I'll try.
Kansas time.
I know. I'm just yanking your chain. Okay, we'll try to pick it up a little bit. But so the question now is, we've talked about income, we talked a little bit about expenses, but now the question is, well, who's a farmer for income tax purposes? And here we have the person and the entity who meets the following definitions as to land use and the activities that are conducted on the land. I'm assuming broadly that many of us on the call are sole proprietors. But we could be a partnership. There could be two people that have gotten together and they are farming together, and the partnership is the farmer. The two partners, yes, they do the farming activities as illustrated here, milking cows, or it looks like cultivating tobacco on the tractor for the product. Could also be a limited liability company. Now, with limited liability companies, and we'll talk a little bit about that, and I've got to watch the time too, is that those are going to be the farmer. Could be a corporation, could be an estate for a period of time as the estate gets settled, or the assets could transfer into trust after an individual passes away. So it just depends on who is doing what, who's controlling. Just because you're doing the work, like this gentleman who's milking cows, but if he is a shareholder in a dairy corporation and he's a employee, that's what he is, a shareholder employee. The corporation is the farmer from an income tax perspective. And just again, not to be pedantic, but there are some unique farmer definitions in the tax code, and it depends on their purposes. And it's about 26 different definitions. They're all very similar, but there are nuanced differences. One is that if your gross income on the tax return comes from farming, then you can make the election not to pay estimated tax payments, but then you have to pay all of the tax that would be due on March 1st. And there's the citation for that. Another one is that farmers, as a group of business people, do not have to keep inventory if they're using the cash method of accounting. Meaning cash method of accounting is you account income when you receive it and you deduct expenses when you pay it, as opposed to the accrual method. Now, other non-farm businesses are allowed this too, but they have to have under $29 million worth of gross receipts in 2024. So farmers, regardless of how much you make, they don't have to keep inventories. I think you would if you wanted to, but that's a definition. And another definition, just as an illustration here, is if you're donating a conservation easement, that you are going to be looking or wanting to receive 100% of your deduction against AGI for this charitable donation, then 50% of your income has to come from farming. Now, up above in the estimated tax, we had another threshold. It was 2/3. So 66.67% had to come from farming. And so the illustration here is you got to understand what is the point of looking up the definition and what are you looking at in this regard. So tax practitioners and their clients, particularly in production agriculture, need to have this understanding of, we're looking at a specific part of the tax code, donating a conservation easement. Do I qualify? And in this case, there's a parenthetical there. This does include timber for this purpose, and it's an encouragement for the preservation of open and green space. And here's just a little bit definition here. I'm not going to read it through, but I just want you to show it to you that under Code Section 2032 Cap A E5, and this is the place where we in the code where we're looking at special use valuation for estate purposes. But here is a really good definition about what farming or the farming activities are and how the tax code would treat or look to how do we define what you're doing there. And you can see, for example, I'm going to look at item B, handling, drying, packing, grading, storing on a farm any agricultural or horticultural commodity in its unmanufactured state. And that's very important, unmanufactured state. So, and there's a couple of things in North Carolina that are specific. So tobacco, when tobacco is harvested, it has to be cured so it will remain stable throughout the marketing and processing time period. Likewise with sweet potatoes, they're going to be processed, they're going to be cured so that they can be stable and then go into the market. But taking a live animal and bringing it to the abattoir, having it processed into cuts of meat, the meat is not a farm product. It's not in the unmanufactured state. Now, my wife likes her steak a little rarer than mine. Sometimes it may be still mooing, but it's not farm product. It's food, it's meat. And so you need to look at that. And they're also looking at the trees, our forestry friends and landowners, that the cutting of trees, the planting, cultivating, etc. So just there. So then the one code right above it in the code is, well, what's a farm? Well, it includes stock, dairy, poultry, fruit, fur-bearing, and truck farms, plantations, ranches, nurseries, ranges, greenhouses, and any other similar structures, primarily for raising of agriculture or horticultural commodities, orchards, or woodlands. So that gets, hopefully everybody on the call can look at that and say, hey, yeah, I'm in here. Honeybees are in there. Other similar structures. Well, that's our hives. Horticultural commodities, agricultural commodities, honey, cut flowers, those kind of things. That would meet the definition of a farm, even if it's being grown in a greenhouse. So just a picture here, a little bit of this thing, just an illustration of what farms are. We've got cut flowers in the upper left. We're picking sweet potatoes in the lower left. We've got cotton, as you can see there, being picked by a cotton picker. It looks like that's a 4-row machine. We've got some birds, those kind of things. And we've got some lambs that look, some sheep that looks like they've just been freshly shorn. These are all just what a farm may be. I tried to put that one in the upper right-hand corner, and now it escapes me. I believe that is, I think, in North Carolina as one of those historical places. So if those are farms, who are farmers? And it could be any of y'all on the call. A young lady running a tractor and plowing, using a moldboard plow. A beekeeper checking on the hives, feeding hogs, looking at, and up in the upper right, we've got somebody that's looking at hemp, and that's now a legal crop, and so that's going to be an opportunity. And then a big industry for North Carolina in the western part, in the mountains, and that's our Christmas tree growers. These are all farmers, and they meet the definition for farming. So as we move through this, when I'm going to use the word farmer, I'm going to use it in the commonly understood definition, trying to figure that out. And the activities that are engaged by the farmer, we're going to refer to those as farming. Again, just trying to set the baseline. I'm not trying to be cute or cheeky, but more importantly, I am going to assume that there's a profit motive and that there is some form of business plan that is being developed or is being followed over time, so that this is not a hobby farm. This is not something that, oh, I want to do something for a tax write-off and hope I don't get audited. If that's the case, I can tell you from experience that does not end well. So that was real quick. Now I want to dive into a little bit more information and looking at that. And here are some items, and I'm going to try to go through the next few slides relatively quickly because Debbie and I get asked these questions. So farm numbers. Everybody may be asked, well, do you have a farm number? And it's for different purposes. So it's a number tied to either the business, and the first big one there would be the federal and state tax ID numbers. So for a sole proprietor, it would be the Social Security number. If there's an individual, if you're hiring labor, then you need to get a federal employer identification number, or sometimes it's shortened out as EIN. And that's for reporting farm business activities if you're a corporation or an LLC or a partnership. But also if you're paying wages, then you need to have those withholdings credited to your account as well as to your employee's account in a timely fashion. FSA, so Farm Service Agency, you may have a number that identifies either the farming unit or units that may be applying for any of the various USDA programs. And just know that this number attaches to the land, not to the farmer per se. Then there's depends on where we are, which county, what the language is, county plat number, and this would identify a unique tract of land. Generally, we're looking at zoning purposes. Then if we're in retail or we're in direct consumer sales, it depends. Are you going to be subject to sales tax? And if you are, if you have to collect and remit the sales tax, then you need to have a sales tax number for that particular business. And that's going to be from the state's Department of Revenue for the purpose, again, collecting, remitting, and then reporting those sales tax on taxable sales. Property tax, sometimes this could be the plat number. It could be the same as, but it is a unique number to each separately titled tract of land. And the purpose there is for assessing, billing, and collecting property tax. I was visiting my parents yesterday. Both of my parents are still living. My dad had gotten a question from the county assessor's office, and he didn't really understand what the question was. And it boiled down to, they were just basically saying, we want to confirm that this is your plat number, that you recognize this. And then he and I talked about, when do you pay the property taxes? And that goes into another story, but that's when you need that property tax number and you make that payment, it's going to tie back. Yep, this property tax has been paid in, and you won't go to a sheriff's sale. Then there could be a Secretary of State's entity ID number. And this is going to be a unique number in dealing with the Secretary of State if there's a reporting requirement, such as with LLCs, corporations, and with some partnerships are going to need to do that. So again, the farm may have 6 different numbers, all for the same farm, but it's for engaging different entities. So this gets us to real quickly to introducing what's Schedule F. And as Debbie and I talk, we're going to have a more detailed discussion on next Monday on the 19th, looking at income. So that's going to be basically the top half of what you're seeing on the screen on the left-hand side. And then we're going to look at the expense side, which on the lower part of the form. But this basically is where we report income and expenses for the farming business, which will generate either a profit or it's going to generate a loss. And it's going to be generally sole proprietors are going to use it. SM LLCs, that's a single member LLC, will use Schedule F because for income tax purposes, single member LLCs are going to be treated as disregarded just for the filing and the reporting of income and expenses on a tax return. Partnerships can use Schedule F as a supplemental form because it makes it a little bit easier, as we will look next week, that the categories or the accounts make sense for production agriculture. Likewise, sub-S corporations that are the farmer, they can also report that farm business activity using Schedule F as a supplemental form. So here's Schedule C, and I've mentioned about that. So this is going to be reporting the business activities of a non-farm, and it has 2 pages. Sole proprietors, and again, single member LLCs generally will use Schedule C, whereas a partnership or a sub-S corporation is going to use Form 1065 for the partnership, or the LLC's taxed as a partnership, or it's going to be 1120 or 1120S form being taxed as a corporation. But for the most part, my focus is going to be on Schedule F because predominantly we've got sole proprietors working here. But here it looks, you can see just quickly, want to identify, we've got an income side, part 1, we've got part 2, expenses, and we deal with that. We've got page 2. So here's where, again, sole proprietors and single member LLCs do it, but we have the opportunity in the for folks that may be doing things like meat. So they raise their own animals and then they take them to the abattoir. Got lamb chops, you might have pork chops, or you might have, cuts of meat. Well, this is where that business actually should be reported because it's not a farming business. And we would be looking at what's the cost of goods sold, which is calculated in part 3, which is the upper third of page 2. So that's where, and I had a conversation today with an individual that is doing this and was really confused. Well, I got a farm, but I do meat. Well, let's talk about it. We had to peel that onion. Yes, she had a farm. That farm's business was to raise and produce market calves to market weight, let's say 1,200 pounds. Then at 1,200 pounds, they go to the abattoir and they get processed. Let's assume that we get a 65% cutout. So we got about 760 pounds of meat products, various cuts. And so that then goes to the Schedule C, and there's a transfer price that would be going from the farm to the Schedule C, and that transfer price becomes cost of goods sold on the Schedule C. You don't want to double tax that income, just as an illustration. So here we go, contrasting what is, what isn't. So over on the left-hand side, we've got farming activities, and we've kind of discussed and defined those. So it's going to be the crop production, cut flowers, honey sales, livestock and poultry production, calves, goats, sheep, hogs, broilers, turkeys, milk, wool, those kind of things. And it's not an all-inclusive list. I'm just looking at. But then when you flip over and you look at Schedule C, you can see, hey, I'm taking milk that my cows have produced, and I'm putting it in through a processing plant or a processing facility on my farm, and I'm making yogurt or cheese or ice cream. Well, even though raising children and showing them what a Guernsey cow was, and they were mostly more brown than they were white, I said, well, those cows, that's where we get the chocolate milk from. And those cows over there, the mostly white ones, the big black and white ones, but mostly white, that's where we get the white milk from. It doesn't work that way. Processing meat cuts, agritourism, fermenting wine or beer, operating a malt house, so distilling spirits and producing soaps from natural ingredients, such as goat's milk soap, which I know several folks do in North Carolina. These are all taking the raw, unmanufactured agricultural product and adding value to them, and then selling them as a finished or a processed product. And it's a Schedule C. And how they transfer from Schedule F to Schedule C is by an accounting method that we call establishing a transfer price. So in the meat side, we're going to take animals, calves, we're going to raise them, and then we're going to sell them, and that sell them is in quotation marks. It's going to be a book entry that goes over to the processing of meat business, and then that gets put into the meat cuts and becomes part of the cost of goods sold. Mentioned 4790, Form 4562. This is where we do depreciation. And as Debbie mentioned just a few minutes ago, she and I are discussing, is this something that would be of value? So I think when she sends out the survey and asks for questions, I can put something together. I have several presentations. We can look at this as a line by line. How does this work? But this is a supporting schedule to both Schedule F. Now, I focused on the farming side, but you would also see that this would also be to Schedule C, where we report the depreciation deductions and various elections that were made relative to acquisitions of depreciable assets, such as breeding livestock, dairy cows, equipment, and buildings. And there are a host of rules that are applied to those. And you can see if you look in Part 3 down in the lower half of the screen, you'll see there's a listing on line 19 that you've got 3-year property, 5-year property, 7-year property, 10, 15, 20, 25, residential rental, non-residential rental, etc. Those are all unique, and we can talk about what fits in those things if you want to have that type of webinar. But again, the question was, okay, here's where we're going to take the deduction, recover the cost of this personal property, and then move forward. And then when we sell it, then we're going to recapture the depreciation. The depreciation expense that was taken is going to be an ordinary and necessary expense, deductible against ordinary income tax, and also deductible for Social Security tax purposes. Form 4797, this is where it's a unique IRS form where we report the sale or disposition of business assets, which we've discussed a few moments ago. And this is separating those items which are going to get long-term capital gains treatment. That's generally, as you see here, on part 1. And then the ordinary items, or the items that are going to be subject to ordinary gains and losses, which you can see on the screen on the right-hand side as ordinary. So that's going to be the 12, the 10, 12, 22, et cetera, all the way up to 37%. So those that get long-term capital gain, if you're selling land that you've held for over a year, or you're selling raised beef breeding or dairy cows that you've held over 24 months, as mentioned earlier. And then for folks that have maybe sheep or hogs or goats, then that holding period is 1 year. So looking at those rules. Also, we use 4797 Part 3, which I'm not illustrating here, just introducing the form. That's where we have the recapture calculation of depreciation on equipment, on purchased breeding and dairy animals, and any sale of any buildings. So we went through a lot. Here's our second pause for any questions.
Okay, Guido, several of the questions were specific to sole proprietor versus LLC. I'm actually going to hold off on those because you haven't even gotten to that section yet. So
Yep.
I'm going to mark those, and because you're going to be covering a lot of that. One of the questions was, do horses fall under livestock similar to cows, like for breeding and tax purposes?
Yes, they do. If those animals are used for a business purpose. If they're pleasure animals, they're not depreciable. But if they're draft animals, or if you use them in a business where you are teaching riding lessons, those kind of things, so there is a business purpose for those animals. So they would fall, and there's a 24-month holding period.
Okay, so just to clarify for the people who asked the business entity questions about LLC, unless your questions were specific to Schedule F or Schedule C, I'm going to hold off on them. So, because he's going to be talking about that later. So if you don't feel like you got your question answered later and you don't hear me ask it, then you can ask it again. Is the difference between a hobby farm and a farm making a profit in 3 out of 5 years?
That's one of the rules we'll look at, and I'll talk about hobby farms towards the end.
Okay, so does an LLC with 2 members use a Schedule F?
It can. An LLC with 2 members is technically by default a partnership, although they could elect to be treated as a corporation. But as a matter of simplification, it is useful to use a Schedule F to report the farming activities, and then on Form 1065, where there is a line for other income, one would make a notation, see Schedule F for detail, and you report on that specific line either the net profit or the loss from that farming activity.
Okay, now this is a very similar question, but I'm going to let you make the call. Is an LLC with multiple members, not 2 like the other question, treated like a partnership regarding Schedule F?
Yes. Remember that a partnership is 2 or more people or entities, and we'll talk a little bit more about the definitions of those. But an LLC with 99 members, meaning you've got 99 owners, and they did not make the election to be treated as a corporation, that's going to follow the partnership rules for taxation.
Okay. Contrasting Schedule F and Schedule C, do value-added vegetable products, for example, tomato sauce, dehydrated teas, do they go on Schedule C? Do they have to be a separate business?
Yes, they are value added. The dehydrated tea and the salsa or the tomato paste or the tomato juice is not in the original unmanufactured state.
And this, I think, is going to be a similar question. A floral design made from cut flowers grown from a farm for a wedding, still part of Schedule F or Schedule C?
If those flowers are in a bucket and you sell them to the florist, it's a farm product. If you take those flowers and you put a fancy little ribbon around them,
Mhm.
and you make and you add value by creating a design, that's a value-added product. That's a Schedule C.
Mhm. Okay, to qualify for a farmer's tax exemption, we need to make a minimum annual amount. I raise beef cattle. If the sold meat goes on Schedule C, but I have to use a Schedule F to prove I qualify for the farmer's tax exemption, is there a way to cross the meat sales over? Hang on, I'm scrolling down. Otherwise, the farm won't qualify anymore because that's my only profit right now.
Yeah. Okay. So let me answer that when I get to the PUV question, because that's a sticky one.
Okay, will you remember or should I try to write it down somewhere?
I'll try to remember.
I'll try. Okay. What's the difference between depreciation and amortization? Is there a dollar threshold for small equipment to be considered as a tool versus equipment? For example, a scale that costs $400. How about motor for a high tunnel automatic opening sidewalls? Is that a part or part of equipment?
So this is getting into a depreciation discussion, but you could have an accounting principle which is written for your business that allows you to deduct anything up to $2,500 that normally would have gone on depreciation. A chainsaw, for example, $600. It has a useful life greater than 1 year, except if you're a logger. But that chainsaw, by definition, because it has a useful life greater than 1 year, is a depreciable asset. But you can, through an election, you could state that anything that I go as a want to purchase that's $2,500 or less, I'm going to write off. So that can be done, and that can be found in a wonderful thing called the repair regulations. But again, that's more a depreciation discussion.
Mm-hmm. Okay, the last question is, are eggs for Schedule F?
Yep, eggs are Schedule F, unless they're fried and put on toast with a little bit of mozzarella cheese.
Don't talk like that around dinner time now. Okay,
Hey, I'm there too.
so we're good on questions. We're ready for you to continue on. Thank you, Guido.
All right, so now we're going to go into some things, and I'm going to again I'm sensitive to the time. We got 45 minutes, and we got about half of the slides to go through, but we've talked about some of these things. One of the things broadly I want to look at and think about is that we've got business ownership, and it depends on where folks are. Sometimes when they retire, like myself, they go, hey, what am I going to do with my time? And they start up a business. But this is a very important graph. It's one that I showed my undergraduate students and said, think about this. And you'll see two things there. When should a business be sold? And when, unfortunately, you'll see that most businesses are held way longer than they should be. But this is just the life cycle, and that's really what I'm trying to do. So we're going to look at organizational structures. I'm going to hit sole proprietors, partnerships, corporations, and limited liability companies. I'm not going to talk about estates. I'm not going to talk about trusts, and I'm not going to talk about cooperatives. These are the general ones that we're going to look at. A sole proprietorship. By definition, one person owns the business. Anybody can own the business, and it's generally the easiest form of operation because one person is the chief honcho as well as the janitor. Now, right now, it's about 83% of American farms, those in the US, are sole proprietors. And when you look at all businesses, 73% of all businesses in the United States are sole proprietorships. What are the advantages? Well, like I said, it's easy to start. They're flexible. You're the boss. You're not working for the man. You get to keep all the profits, but you have all the records, you have all the reports, all of that stuff. What are the disadvantages? Do you have enough money to begin and continue the business? you have personal liability for all the debt and all the legal issues, depending on how much liability insurance you can afford. And you have the issue of continuity. Typically, the business stops when the sole proprietor dies. About taxation. Well, all profits are going to be taxed at the individual rates, what we've been talking about all evening. Profits are subject to the self-employment tax, and the operation, as the individual, you're the sole proprietor, you are management, you are labor, and you are the janitor. You get to do it all. Now, it doesn't mean you can't hire people to help along that way, but that's broadly what a sole proprietor is. Now, when you look at a partnership, now by definition, a partnership is two or more individuals or entities, because you can have two corporations that form a partnership. But it's two or more individuals or entities that agree to combine efforts and resources with a profit motive. Now, broadly, there are two different kinds of partnerships. The first one is listed there as limited. So they want to contribute money and assets to the company, but they don't want to have any say in management. They don't want to do the work. They're just looking at it as a passive return on their investment. And the liability that they're exposed to is to the extent of their investment. If Debbie and I form a corporation, a partnership, and I say, Debbie, you're young, you got all this, I'm old and white-haired. I'll tell you what, I'm going to kick in $300,000, and you're going to be the general partner, and I'm going to be the limited partner. You get to make all the decisions. The most I can lose is $300,000 because that's what I put in. Now, the other kind is the general partner, and they have there's at least one general partner in any partnership. There could be several different general partners. They get to make decisions. If there's more than one general partner, there's some type of operating agreement, how major decisions are made. Basically, there's generally in the organization, or should be in the organizational document, that says, financial decisions can be made by general partners to a limit of $5,000. Anything above $5,000, we have to have a meeting and we have to come to consensus, or we have to have a 2/3 vote if there's more people involved. We're also liable, general partners are liable for all actions of the partnership. What are the advantages? Well, one advantage is there's a formal agreement. The partnership owns the property. It owns that, and individuals have an interest in that partnership, and then by that, indirectly, an interest in the partnership assets of equipment, livestock, and land. They share in the profit and loss on a pro rata basis, and it's flexible. The partnership can say, hey, we want to change things, so you just change the organizational structure, or you add something. It does allow for continuity, particularly if there's two or more partners. Then what happens when one partner wants to exit? Well, then the partnership can buy his or her interest out, or that partner can sell his or her interest to somebody else with the agreement of the remaining partner. So it has that opportunity. A disadvantage is that each individual partner has unlimited liability for the entire partnership. So in Debbie and my case, we're a general partner. I put in $300,000. She put in $300,000. Our capital stake is $600,000. We leverage that, and we go out and borrow $2 million. And now we have a total liability of $2 million out there. Now our net worth is going to be $1.4 million, is going to be 600,000 versus that. But now she is liable for $2 million, and I'm liable for $2 million to make sure, because we go back. So that's maybe a disadvantage. The general partner, unless there is a rule within the partnership operating agreement, they can bind others. And I have seen this. I have seen father-son partnerships and somebody went out and bought a brand new tractor because they wanted to buy a brand new tractor, but the partnership really couldn't afford it, and it got them in a bind and do that. And there could be there limited provisions for continuity if nothing is specified. It can stop at death. You got to look to the partnership agreement, what's there and carrying on relative to that. Taxation, as I said, it gets split pro rata between the individual partners. The partnership files a return, but the profits are going to flow through to the individual partners on their pro rata basis. When we operate that, they're going to share the profit and the loss, going to share control, going to share management. The general versus the limited partners, we need to understand who that is. There could be a firm name. It could be Guido and Sons LLC partnership. There's going to be one set of books, and that is going to derive and drive how at the end of the year, did we make money? Did we not make money? If we made money, how does that get split out? If we lost money, how does that get split out? It does split ownership between individuals, and we're going to have a separate bank account for the partnership itself. Then we get to corporations. So a corporation is a legal person. It's a paper document which separates the owners, the employers, and the managers. We formally organize, and it's going to be recognized by the Secretary of State's office that this corporation is licensed to conduct business in the state of North Carolina. There are generally two kinds. One is called the Subchapter C Corporation, which would be like General Motors, Ford, Coca-Cola, et cetera. There are going to be many classes of stock. And if you read the financial papers, you see that they'll talk about preferred stock, they'll talk about Class A stock, Class B stock, Class C stock. One of the probably more common ones for small operations, still wanting the corporate type of structure, is the Subchapter S Corporation. These can't have by statute any more than 100 shareholders. Now, family attribution rules treat the family as one shareholder, so there's actually a way to get more than 100 people in. And there's only one class of stock. If you violate either one of those two rules, then you revert to a C corporation, and that may not be what you want. There's limited liability. The personal assets are protected and can't be touched. Generally, that's a broad general statement, unless the corporate veil is pierced. Continuity of the business, the shares of the company can be given or sold to children or to others. One corporation can buy out another corporation. We read about those kind of activities in the financial papers that happen with a lot of frequency. What are some disadvantages? Well, the disadvantages are the cost of establishing. I would not form a corporation by going online and using Mr. Google and say, I want to create a corporation. Number one, I'm not an attorney. Even though I can read and I can think I understand, I don't want to make and do this without some legal counsel. There could be accounting fees. There are meetings that are required. For bylaw development, for policy, you got to keep minutes. And in a C corporation, there is the double taxation issue. So dividends issued by a corporation are not deductible by the corporation, and then they're going to be taxable by the recipient, the shareholder. And so the corporation is going to pay tax on that income, and then the individual is going to pay tax on that dividend income a second time. So that's why a lot of folks don't choose a C corporation today. With a corporation, its operation is typically going to be formed and operated by an agent. That's going to be the shareholders. There's the formal structure. It could be a president who's hired. Doesn't have to be a shareholder. Vice president, secretary, treasurer. Typically in a closely held corporation, family corporation, those are going to be members of the family, and they're going to be shareholder employees. because we don't get anything done unless we've got people doing something. So that gets us to the limited liability company. That's the new kid on the block. It has the aspects of a corporation. As I mentioned before, single member LLC. For tax purposes, it's disregarded and files a Schedule F. If it's got 2 or more members, it's presumed to be taxed as a corporation, but the LLC can make the election to be taxed as a corporation, and then further choose whether they want to be a C Corp or an S Corp. What are the advantages? Well, it's similar to a partnership. It does have limited liability unless the corporate veil's pierced. There's no double taxation. What might be some of the disadvantages? Formal. Some people like formalities, some people may not. It does require interaction and registration with the Secretary of State's office. You can't deduct fringe benefits for members from income like you could in a C corporation. And I really don't see that as being broadly beneficial to individuals today. There are some continuity issues due to the newness of the LLCs, but it's becoming less of an issue because we've had almost 30 years now of the experience on how to use them. So we've been developing those items, and then we go ahead and operate those, and now 30 years down the road, we're shutting some of those down. Taxation, and here it depends. It could be taxed as a partnership, and so the profits and losses flow through to the members and then get taxed on their individual return, or they can be a corporation, and then it could be taxed. If it's a C Corp, the corporation pays tax itself. If it's an S corporation, it's going to flow through to the shareholders. In operation, there's a whole bunch of different options available, and that's why folks like LLCs. You could elect corporate status, you could elect sub S status, whatever you want to. It's really, really a nice, flexible thing. And Andrew Brannon is going to do a job on that, discussing that in more detail. Now, thinking about entity selection, considering what type of entity meets or fits best today, that actually may change over time. I strongly suggest consulting a competent attorney and or a tax specialist, because I can tell you that Help Me is much cheaper than Fix Me. And it just behooves people, I think, if they want to get serious about this moving through. Seek information from other folks that are using various types, and then looking at those. Now, one thing that has raised its ugly little head is that those entities which have been organized through the Secretary of State's office are now required to report to FinCEN. FinCEN is the Financial Center, Financial Crimes Enforcement Network. And we have to look at beneficial ownership interests, and it's basically trying to bring people operating in the dark into light, and to prevent money laundering and those kind of things. But it's added another burden to individuals. So real quick, any further questions or anything there relative to entity?
Well, someone had asked about the advantages of LLC versus the sole proprietor. I know you talked about, do you feel like you handled that, or?
Well, I would answer that the LLC, if properly managed, can protect the business operator from some liability. Meaning that if you are acting truly as an agent of the LLC and something happens, your personal assets might not be brought into court. Now, the practical pig is, if you're a single member LLC, everybody is going to get sued. The LLC is going to get sued, you're going to get sued, and you're going to have to sort out Was this an intentional? Was this negligence? What was this? And let's assume the best. This was just an error at the business level. Then more than likely the court will set aside the personal assets and they'll just look to the business assets for any type of recovery if there's a claim. If you are in the food business, so if you are raising hogs, if you're raising cattle, if you are raising poultry, if you're raising whatever, and you're providing food items, cuts of meat, broilers, those kind of things going to the consuming public, I think a limited liability structure for your entity would be very, very wise, and I would strongly encourage it. Visit with competent legal counsel, because as a sole proprietor, if somebody gets food poisoning from your meat, whatever, and dies, you could lose the whole kit and caboodle and then some.
Okay, so I'm going to keep moving at a clip here. Can we be a sole proprietorship forever?
Yes.
Is there advantage to converting a farm from sole proprietor to LLC? I guess you've just kind of tackled that.
Yeah.
I don't know if you could answer this one. Which one is best for a husband and wife?
Two of them.
Okay.
No, that was a cheeky response.
Yeah.
It depends on what the goals are. I can't give just a blanket answer.
Right.
I'd have to have a longer conversation.
Right. So when you were talking about taxation under a partnership, you mentioned the phrase the profit was split pro rata. What does that mean? What does pro rata mean?
Pro rata means by your ownership percentage. So Debbie, if you and I formed a partnership and I was a 30% partner and you're a 70% partner, pro rata means if we made $100,000 in profit, you would get $70,000 and I would get $30,000.
Mm-hmm. Yeah, that makes sense. The last question, well, not quite. What does the phrase "the corporate veil is pierced" mean?
Okay, so that's the line. It's a figure of speech, keeping your personal business personal and keeping the business business, and don't mix the two. In other words, if you've got a corporate checkbook and you go and on your way home and you don't have any cash, okay, just making that example. If you go on the way home, you get a phone call, says, "Oh, honey, can you stop by the grocery store and pick up some milk and some eggs and some cheese?" And you get in the grocery store and you realize the only thing you've got is the corporate or the LLC or the partnership checkbook, and you write a check for a personal expense, that's piercing the corporate veil. Now, what you could do is go back and reimburse that business entity for that. It's cumbersome, but the whole key point is you don't use the business as your own personal bank.
Mm-hmm.
You keep business, and you keep personal.
Okay, last one. What is the expected cost for switching or starting this process?
Depends on how complicated you get, and it depends on what local attorneys will charge. I've seen it generally anywhere from $1,000 to $1,500 for something relatively simple, to several thousands of dollars, depending on how much time and exactly what you're trying to accomplish.
And part B of that question. Oh gosh. Oh, they just started coming in again. Okay. Hang on. Oh God. If I don't turn a profit in the first years, what's my liability? So I keep getting, I get keeping things separate, but if I use the personal money for the business, is that also bad? Is that also bad? And how do I account for that at the end of the year with the accountant?
Okay, so that what you're doing is, depending on, again, the entity, you could be contributing additional capital which increases your basis in the business. And if the business has a loss, then you can take the loss against other income that you might have. And again, that's getting into taxes and gets really, but I'm trying to answer the question as simply as I can.
Mhm. Okay, if it's our living, how do we move money from the business to our accounts?
Well, if you've got a business account for the farm that's a sole proprietorship, you write yourself a draw check from the business, $1,000, and you deposit it into the family living check, and then you use the family living checking account to buy the groceries and to buy, clothing and that sort of stuff for personal expenses.
Okay, one more question, then I'm gonna let you finish your presentation.
Okay.
Piggybacking on the corporate veil issue, how do you reflect additional investment of personal cash into the business? I know going from the business to personal account would be a draft, but I don't know about the opposite direction.
Well, depending on the entity type, it's going to be treated as additional capital, and there needs to be records for that because, as I said, that increases the basis. And again, this gets deep into the weeds real quick. It increases the basis, your basis in your business. Now, if it's a Schedule F sole proprietorship, you ought to keep track of that just from a business management perspective, because if you're losing money, is it greater than depreciation, whatever the depreciation amount is? Because if it's greater than the depreciation amount, then you are consuming equity, and you're decreasing your net worth.
Okay, thank you, Guido. We've got about 20 minutes before the end of the webinar.
I think I can do it.
Okay.
All right, so here we are. We're going to look at PUV, and there was a question back there, and I want to look at that in just a moment. This is North Carolina, and this is an overview, and there are other individuals that are doing presentations, and Debbie knows whose they are. But so PUV, present use value, is the deferred property tax program for rural landowners, and it should be considered. Now, it has to be applied for. It's not a given. So if you purchase property, you need to tell the county assessor if it is under current present use. In other words, if you buy farmland from a farmer who's retiring, then more than likely it's under PUV, and you want to tell the county assessor you're going to continue farming. And so that present use continuation will get that treatment. It has to meet certain ownership requirements. That's titling. Typically, it has to be to a natural person, which is a living, breathing individual, a human, but it can be also in a partnership or an LLC or a corporation if the owners of those entities are natural persons. It has to have a certain acreage size to begin with. For agriculture, the parent tract that involved in agricultural production has to be 10 acres. So if you have a 10-acre piece of property and you live on that property, generally you're going to have the homestead of 1 acre. That leaves you 9 acres that you can farm on. That is less than 10. That property will not qualify individually for PUV. For horticulture, the parent tract has to be 5 acres, and for forestry, the parent tract has to be 20 acres. Once you have met the parent tract qualification, then you can add smaller tracts to PUV within the same county, or if you're across county lines, within 50 miles. Now, you have to have productive income, and here's where that question came. So if you've got land that you're being used for production of beef cattle, but you're selling cuts of meat and you're reporting it on Schedule C, that's not going to qualify as agricultural income for PUV. That's why I would suggest you split your business into the 2 businesses that actually exist. One is the farming business, where you're raising the market animals, and then you have a transfer price of those market animals to your Schedule C meat business. That should qualify you for PUV on that property. Meat is not an agricultural product in its original natural state. And to the best of my knowledge, it would fail for PUV. And if you're forestry, then you have to have a forestry management plan. Or if you're farming, you have to be following best management practices on the farming as well as with the horticulture. Now, last year, and this was a question that came up, and Debbie forwarded this question to me late last week. There was a change in the statute for PUV regarding honey. And I've got that over there on the next one. This is looking at the North Carolina Farm Bill, and it's several pages long. The first section actually deals with this. And when you look at it, it says the purpose of this particular section is to include income from the sale of honey in gross receipts for the purposes of present use valuation. And when you go all the way down to, so that means that when we're looking at trying to meet that $1,000 from land, honey sales are going to qualify. And what it did was it cleaned up the language. If you look at the lower right-hand side, you'll see the redaction in it. What they've done is they've redacted out basically the phrase other than honey. So if you look at that, the sale of bees or products derived from beehives, and that's honey or wax, and there are folks that might be using the wax for other products or any other payments, et cetera, et cetera. So what you see at the right-hand side, the redaction moves the words other than honey, and then implicitly then leaves that the product from the beehive, the honey, is going to be allowed as an include. So if you've got a 10-acre tract of property that is being used and you want to get it for under agricultural PUV, you have to generate $1,000 of income from that, and honey now is going to qualify. And the effective date for this was January 1 of 2023. So for most folks who are using a calendar year, this will become effective for 2024. So I hope that's helpful and clarifying. One thing to be aware of is that if land converts to use other than PUV, then you're going to have deferred property taxes. They're going to be collected for the current year plus the 3 prior years plus accrued interest. And just as a practical matter, you might want to consider that as part of the sales terms. Sales tax. So this is from 50,000 feet, and there's going to be a sales tax presentation, I believe, by Andrew Brannon. We'll talk about that a little bit towards the end. I think that's on March 4th. So under the North Carolina rules, as I understand them, farmers are provided exemptions from paying sales tax on certain listed farm inputs. Now, you have to be a qualifying farmer, and the last time I checked, you had to have $10,000 of farm income. Now, there is a conditional farmer, and that would be for beginning farmers. It's good for a limited time, and I believe that is still 3 years. And so how do we define that individual? Well, are you engaged in farming, and are you generating $10,000 worth of farm income? If you're not, then you could qualify as a conditional farmer, 3 years, and that would get you up to $10,000. My understanding is in my conversations with Farm Bureau back in 2016, 2017, when this was coming and becoming a little bit more, is that once you cross the $10,000 threshold, apply for the qualifying farmer, and then you're golden. You don't have to approve it anymore. When you look at now the other side, do you have to collect sales tax? If you're selling an agricultural product in the original state, then there's no sales tax collected or remitted. But if you're selling value-added products, then the obligation and responsibility to collect and remit sales tax becomes required. And you got to figure out, are you selling food that is at one rate, or are you selling something that's other than food? Then it could be the state rate plus a local rate of whatever the sales tax adds up to be for the county in which that product is sold. Now, there could be some exceptions, but again, that's a really quick 50,000 foot view. But in a couple of weeks, Andrew Brannon is going to address sales tax issues in more detail. Another question that Debbie and I get asked all the time is, and I hope that by now you might appreciate, what's a bona fide farm? And my comeback is, what's the purpose? Mostly it's going to be for identification, potentially to access benefits or operations per some set of regulations. So you've got some federal purposes: USDA, IRS, employment taxes or payroll, U.S. Department of Commerce, and Small Business Administration. You may be interacting with those and they may want to know, what's your business? Well, I'm a farmer. USDA broadly has used for years and years and years and years a broad definition that if you generate $1,000 of agricultural revenue, then you're a farm, for calculation purposes of looking at how many farms we have and that sort of stuff. For state purposes, there could be different rules there too. And one was that came up in 16, 17, and 18 was, could I get a license or a permit to grow hemp? And under the North Carolina rules at that time, individuals had to file a Schedule F and prove that they filed a Schedule F and were a farmer in order to grow hemp. There's also the sales tax exemption, which we just talked about very briefly a moment ago. There's also some county purposes. So plat number, parcel number, and the title of that real estate for being in a voluntary ag district, for being included in the deferred property tax program. It's a state program, but it's administered by the county. Could be also within zoning issues within a county. There could be some ETJs, which are extraterritorial jurisdiction outside of a city, how those are. So there are various different reasons, and we have to parse what those reasons are. Now we get to a question looking at the hobby farm. So if there are continuing or continual losses, then IRS may send you what I refer to as a love note, and they're going to apply Code Section 83, which are the hobby loss rules, which may limit or disallow any of the deductions. I personally would encourage folks not to use the word hobby. You're a farmer and you have a profit motive. The burden of proof is going to be on the taxpayer, the farmer. So what is your intent? Well, my intent is to farm. My intent is to have a profit. And you're going to have to show a profit 3 out of 5 consecutive years. And that begins by looking back from the year that IRS is auditing or reviewing. So if they are reviewing tax year 2022, they're going to go back. They're going to look at 22, 21, 20, 19, and 18. What happened in those 5 years? Did you show a profit of those in 3 of those 5 years? If yes, then the burden of proof falls over to IRS to say, hey, then you aren't a farm. If you're an equine business, it's 2 of 5 years. That's just a special rule for the equines, probably the horse lobby out of Kentucky that helped get that passed. IRS uses a list of items to decide if there are continuing losses, whether this is a hobby or not, and which part of the farmer's task. And it's going to be part of the farmer's task to prove that you've got a tax profit motive. And then IRS is also going to apply a facts and circumstances test. Here are those things that you want to consider and continue, and to be able to document and prove if you've ever gotten audited. You operate in a business-like manner. You got business cards. You put yourself out at the farmer's market or whatever. You seek advice. part of this is put this in your diary. You attended this 2-hour webinar to learn more about taxes. Make a notation of it. Amount of time that you spend in the activity. Looking at the value of the assets that are growing. If you're a nursery business, you might be starting with some really unique cultivars that you then are going to propagate and move from the parent plants, and you're going to start selling. The value of those continues to grow as your inventory grows. You have a profit motive. What's the profit and loss history over time? What other income sources do you have? Do you have a public job and you got a nice W-2 and now you got the loss? What kind of personal pleasure or recreation do you have out of this? So you think about those things, and then as we're kind of wrapping up here, trying to think about that, trying to get your tax returns prepared. Well, you could do it yourself. You know your business the best. But however, do you understand the language of tax in the context of your business model? And sometimes that's complex and very nuanced. You could have your return prepared by CPA, public accountant, enrolled agent, or somebody that's uncredentialed. There's nothing wrong. There's a lot of people out there that are really smart and they know what they're doing. But the question is, does the professional understand the language of agriculture in the context of taxation? Does the professional have a significant portion of their practice in agriculture? Does the professional understand your business model and what your goals are? And here's some sources, and I'm not just look at those, and Debbie has made these available to you. And what I would encourage you to do is to interview. You know, ask the preparer, what do you have a significant portion of your practice working with farmers? Yes or no? Do you take specific continuing education relative to rural and farm taxation issues and updates? For over 20 years, I did an 8-hour tax workshop specifically for CPAs and tax practitioners dealing with agricultural businesses. How many years have you been in the business performing, filling out tax returns? How many farm-related tax returns do you complete annually? And do you help with other business issues such as continuity and succession and transition? This is kind of a thing of where you're going. This is as your business grows. I'm just going to let you look at that yourself as it goes through. And at the end of the day, do you want to pay taxes? Yes, you do, because it means you're making a profit. And Uncle Sam is never going to take all of your profit. The maximum tax rate's 37%. However, you don't want to pay more than what's required. In other words, you don't want to leave a tip on the table. We've mentioned these before. So next Monday, I'm going to do an in-depth discussion on Schedule F. On Wednesday, I'm doing expenses. On March 4th, we're looking at Andrew Brannon is going to do sales tax issues. And then we're going to also, he and I are going to do one together in August, looking at business entity formation and tax implications. He's going to do the legal side. I'm going to talk about some of the tax implications and some of the decisions, and that might help folks determine which entity fits. And even if you've already made that decision, it's a good way to review, did I make a wise decision? So Debbie, we've got 5 minutes or so. I got through all the slides. We've stopped 3 times for additional questions. Are there any last questions?
Yeah, thank you, Guido. There are, and I'm afraid I'm just going to have to skip the ones about Schedule F since we literally have 2-hour webinars next week on that. I think a lot of people tonight are signed up for those. If not, you have the opportunity to sign up for those. You know, today was about kind of an intro to those. So I'm going to kind of zero in on questions that are not going to be covered next week. Here's one. If the homestead on a 10-acre land is a barn dough, which is a condo as part of a barn, can you avoid being disqualified by the 1-acre loss accounting for the homestead on the PUV application?
My gut says probably not, but that's going to be a county assessor decision. And more than likely, you got to remember that county commissioners are putting pressure on assessors to generate revenue so that public services can be provided.
Thank you. qualifying for the sales tax exemption from provisional, is the $10,000, is that gross income on sales in 1 year or profit?
Gross income.
Yep. Also, if I split the business and have two LLCs on this farm, one for raising cattle, one for selling the meat, can they work together to qualify me for the farmer's tax exemption? The meat qualifies me by profit, but most of the expense is in raising the cattle, and that's where I need the exemption.
Yeah. That's when I would look at the transfer price between the two businesses to make sure that that makes sense. And you're not double taxing. What you're doing is you're moving income to the Schedule F where you might need it from your meat business. At the end of the day, you've got the same cash. It's just being treated as coming from two different businesses.
Okay. Is there a full and extensive list of sales tax exempt purchases? I couldn't find one.
Yes, there is. And it just is, it's in the process, actually. I understand it being rewritten because there of that legislation that I just showed you relative to the honey, they added a few things there. And there is a sales tax bulletin. What you need to do is go to the North Carolina Department of Revenue, the sales tax bulletin. Debbie, I might be able to find that a little bit quicker tomorrow, and I can send you the link and you just add that to the resource document.
Somebody just put a link, and I know Andrew Brannon, who's going to be teaching the
Yep.
sales tax webinar, he's working on a new NC State publication on sales tax. So
Yep. That and that might be the better thing to do is just wait for that.
yeah, and I encourage y'all to sign up for that March 4th webinar. That is a free webinar. We taught that last year, and people wanted more in depth. So we're now devoting an entire webinar just on the sales tax. So that's what I mean by we listen to the feedback. So there'll be lots of details about it. Does anybody have any final questions for Guido in our couple of minutes that we have left? The nice thing about this webinar, I mean, he threw out so many details there and so, many detailed answers, which even if it wasn't your question, I hope that y'all found, answers that could help your operation. But the great thing about webinars is you can go back and listen to it. And that's what people were telling me in the feedback is you can really capture a lot of helpful things when you go back and listen to the recording. Because there's just a lot of stuff in there, a lot of good stuff. So thank you, Guido, for sharing all of that. And
Yep.
like I said, I'll be sending out an email to y'all, and the recording will come later. Let's see here. Question about the upcoming webinars. Well, the links to sign up be included in the email, yes, but yes, they'll be included, yes. But y'all are probably already on my email list. I've been sending them out. Yes, so any last chance for questions? I bet everybody probably wants to go get some dinner. I'm just looking through the chat real quick, Guido, to see if there was anything. I can't, it's not a good format that I can really, there we go. I'm expanding it there.
Yep.
Okay. Yeah, the Schedule F, like I said, he goes into such great detail about that, and you'll be looking at your Schedule F form while he does it. We'll send out the presentation the end of this week, just like we did. I don't know how many of y'all printed out your presentation ahead of time. I'm curious, but it's just something to follow along. I think that helps to be able to follow along there. But we, use that evaluation when I send it out to give us your ideas for future webinars. Like I said, besides the one that Guido mentioned, all of those that he mentioned, we're looking at one on depreciation, and we're looking at just doing that open Q&A. That would be an unusual one. That would be a first. And it's not like you can use Guido to be your personal tax consultant. It has to be a question that can benefit other people. But normally we have a little more time at the end for just open Q&A, and this one we kind of paused regularly, so I think people kind of asked their questions as we went along, which I think is also good. This one question said, on the bulletin, it still says They must have been looking at the link that someone sent out. It says of the sales tax exempt, it says this is not an all-inclusive list. Yeah.
Yeah. And the thing with that is that items come and go. There are things that in legislation get inadvertently left out. Like for example, in Nebraska, that they put in a sales tax exemption for baling net wrap. But they left, when they did that, they left out baling twine and baling wire. Those are two other ways that small square bales and large bales are wrapped and contained. So, you know, I guess from a practitioner standpoint, I would say, look at it. If it seems reasonable and it fits in with kind of the categories that are on the list, then I would argue for that. But again, the vendor is going to have probably the more up-to-date list, or should have the more up-to-date list. And you just have to provide them the certification that your sales tax exempt. But a lot of this stuff is not set in stone. A lot of this stuff is moving. It's fluid.